Hello everyone, and thank you for joining us today for Hay Group's Reward in China webinar. My name is Larissa Stefanishin, and I am part of Hay Group's team in Philadelphia. I'd like to let you know that today's webinar is in listen-only mode to minimize the background noise, and we encourage you to send your questions through the chat feature at the bottom left of your screen. We'll be reviewing your questions at the end of the presentation. Also, please note that you can maximize the screen in the upper right-hand corner just to make the slides a bit bigger and easier to read. Today's call is scheduled for an hour, and we'll spend about 40 minutes or so going through the presentation and leaving the rest of the time for any questions that you have. Lastly, please know that all attendees will receive a copy of today's presentation. Today's presenters are Wendy Nichols and Joe Chu. To provide you with just a little bit of background information about the presenters, Wendy leads a business unit across North Asia and Pacific, which provides powerful and intuitive online tools to gain world-class insight into people, pay, and employee effectiveness. These tools allow clients to uniquely benchmark their company against the best worldwide and accurately measure what really matters using fact, not opinion. The business unit is part of Hay Group's global network, which provides data and tools in over 100 countries across the world. Over the last 15 years, Wendy has worked with a wide range of clients across many sectors and countries to understand the requirements and assist in their human resources planning. Wendy has designed HR solutions to suit clients' needs, ranging from the high-level global frameworks to detailed decision-making for a local executive position. Her work with Hay Group has been in Europe, Asia, and Pacific. She has worked in many of our offices, including London, Sydney, and Shanghai, and Wendy has been in China for the last 3.5 years. Joe Chu is a consulting director and China Reward business leader. He's responsible for the total remuneration services for Hay Group China, providing consulting services to the clients in developing total reward strategies, establishing grading structure, developing compensation system, and designing variable incentive plans and organization effectiveness studies. Some of Joe's clients include Apple, Google, and Microsoft. And with more than 12 years experience in human resources management and HR consulting areas, Joe has extensive relevant experience in the HR world. Now, to kick off our presentation, I'd like to pass it over to Wendy.
Good morning, everyone, and thank you, Larissa, for that kind introduction. So, just over a month ago, Chinese New Year brought in the Year of the Horse on January the 31st, not January the 1st. The Year of the Horse was well celebrated. People are happy, optimistic, because the horse is considered the strongest, intelligent, and fastest animal, and so it's going to be a good year. In China, the Chinese New Year is also known as the China Spring Festival, and it's time for family reunions, buying clothes, participating in parades, but most importantly, bringing in good luck for the new year. So just from this little example, you can see that things might be called New Year, but they're done differently in China. A different date, a different reason, and a different celebration. What I would like today's presentation to be is to take you through some of the HR and reward areas that might also be called the same thing in the US, but perhaps are done a little differently in China. I'm hoping to explain some of the facts from the myths when you're setting your salaries in China. So for the agenda, as Larissa said, it'll be about a 40-minute presentation. I will start by just covering a few global trends to give you an overview of how China is currently viewed, and then I'll present 6 challenges that I believe you're likely to face when you are looking at reward in China, and then happy to answer some questions at the end. So reward in China is an enormous topic. Given we have 40 minutes, I'm going to touch on each of these 6 challenges fairly lightly, but if you wish to know any more detail or discuss it any further, Hay Group would be more than happy to assist, and you'd be welcome to contact us. So most mature economies are just coming out of several years of recession or low growth and are still facing some difficulties. Of course, the emerging markets have been growing at much higher rates, and the focus has been on them for many years. This Economist article that I show you here is actually going back 8 years now, when the emerging markets really started to show their presence and their influence. A recent study by McKinsey is also showing that out of the 440 emerging cities, they're going to produce 50% of the world's GDP growth in the next 15 years. And the world's population, which will grow by around 20% in the next 10 years, will also come out of the emerging markets. But of all these emerging markets, China has shown phenomenal and consistent growth, and so that's why it has been seen as a real highlight within the emerging markets. So let's look a little more into China. What the map is showing you is foreign direct investment. This is the direct investment into the production or business in a country, say China, by either an individual or a company of another country, say the US. And this investment is made by either buying a company in China or expanding operations of an existing business into China. When we look at the foreign direct investments, China is very strong. And this means that many foreign companies have invested in China. Actually, China is the world's largest international trading nation, driven mainly by the manufacturing industry. So I'm not sure if you know, China is now producing 80% of the global air conditioning, 70% of notebooks, 65% of refrigerators, digital cameras, so an enormous manufacturing industry. So it's a very prosperous country, and therefore the world's eyes are being on China. A recent global CEO survey asked CEOs what their global strategic market is, and 83% of them have chosen China. And many foreign companies have made some brilliant achievements. But at the same time, the Chinese enterprises have really grown rapidly. And what the graph on the right can show you is many of them have become the world's top 500. There are now 95 companies that have entered the global top 500. So 1/5 of the Fortune 500 are Chinese-owned organizations. So the future looks bright for the year of the horse, right? Well, let's have a look at some different data from a different angle. It's interesting when you have a look at the GDP growth rates from the Economic Intelligence Unit. What you can see is that although China has an absolute higher growth rate, the trend has actually been declining over the last few years, whereas the US economy has been improving, and so the gap in the growth rates has closed a little. But this is on purpose. The US government is stimulating growth, but the Chinese government has a current 5-year plan in place that is really focused not on absolute growth, but on investing in raising the middle class of China into consumers and making the economy more productive. So the 7% growth that we've seen over the last few years is likely to stabilize and continue for another few more years. But what this means if you're a foreign investor in China is it means you have to work harder to get your growth in China. It's no longer just as easy as coming into China and riding with a growing market. It's actually getting a little bit more difficult to grow in China than it has been over the past. So I'll show you a more recent copy of The Economist. Foreign companies are making brilliant achievements in China, there's no doubt about it, but they're not always meeting the CEO's expectations. So of this recent survey that was done, 78% of companies are expecting to gain market share in China. But with growth slowing, wages rising, and only 13% feeling that they even have an advantage over the local competitor, you can see that there's quite some concern. There's some real governance issues happening in China as practices are being tightened up, and there's also an additional complexity of many companies needing now to have a multi-strategy approach into all the different regions of China and not just treating it as one market. So it looks like the ideal and the reality has quite some gap in China, and many companies report that life is getting harder for foreign companies. What's quite interesting is that companies are often reporting the largest gap is on people issues. In the eyes of many Chinese HR, they feel that global headquarters is looking for more control and more ways of applying the headquarter ways into China. But the local HR in China often feel that they wish there was more of an international perspective and in terms of looking at a problem rather than trying to approach it from a headquarter way of thinking. And they're always asking global headquarters to try and understand more of the local flavor to some of these issues. And this is something we see all the time when looking at reward in China. Foreign companies are grappling with the local market circumstances all the time and trying to find ways to fit in. Here is a quote directly from one of our clients as part of an interview process. And I think many of you will have experienced this when you look at your own reward within China. It says, to compete in the war for talent, the management invested lots of time, resources, and energy in designing good pay programs. But every time a talented employee leaves the company, our pay structure gets thrown out the window, and they try something different. So companies are trying to find different ways of working in China and not finding it very easy. So just like the Chinese New Year celebrations being different to the New Year celebrations you might be having, so mature Western markets have different pay to what's happening in China. I've selected 6 topics here that regularly come up when we meet with foreign companies in China, and I'm going to go through each one of these challenges at a high level and try and explain what's causing them, what's underlying these things, and what are the real challenges. For each of the challenges, I will start by actually giving you a client quote or a typical conversation that we hear from a client that's operating in China, and then we will try and show you the underlying data that's sitting behind that. So the very first one we're going to have a look at is high wage inflation. We very often hear from an overseas headquarter that the expectation for a salary increase seems to well outpace what the market indicators are saying in terms of growth rates, inflation rates, etc. So this is something that we hear many, many times from headquarter companies who are operating in China. So let's have a look at some of the data. To look a little deeper in the issue, here are some of our recent salary increase data from the Hay Group database over the last year that was collected. On the far right, I've put a red mark around. You can see that salaries on average have increased around 8.4%, forecasting to increase about 8.5% over the next year. Please note these numbers are a little bit lower than what you may have seen over the last couple of years, so things have become a little bit more prudent on the salary increases. So if the salaries are increasing at around 8.4, 8.5%, and as I've already explained to you, GDP is shrinking, I also want to put onto the same graph what inflation looks like. So this graph is showing you in the gray the GDP of China since 2008, in orange the inflation rate, official inflation rate that's recorded for China, and in green the salary increase that has been awarded. What you can see is that wages have not shown the decline that growth rates and inflation have shown over the last few years. What this means is that there's still relatively increasing labor costs. If we were to remove inflation away from the actual salary increase, then that's what you get. What's remaining is what's called wage inflation, the real increase or the take-home money that you can put in your pocket. And China has one of the highest wage inflation rates in the world, meaning the actual salary increases is significantly above the inflation rate. And wages will continue to rise faster than inflation. This is the reality in the short term in China. The China government intends to grow the wealth of the majority of its population and create a larger middle class that will be consuming. This is going to create a more sustainable future for China, where their own population, which as you know is the largest population in the world, can actually consume their own production and rather than rely heavily on exporting out to the West. So this is quite a purposeful structure that the government are putting in place here. But one of the inevitable results of China's economic development is leading to more and more labor costs, and no more so than the cities outside of the first-tier cities. First-tier cities are those cities of Shanghai, Beijing, Guangzhou, and Shenzhen. Those are the cities where investment has already been, the labor costs have already gone up significantly, but now where the real pressure is and where the real labor costs are rising is actually happening in what we refer to as second or third tier cities. And what this table is showing you is the minimum wage, the government gazetted minimum wage in 2012 and 2013, so that we can show you what the increase has been, an annual increase has been on the minimum wage in some of these cities. and therefore the pressure on the minimum wage is obviously putting pressure onto the other salaries that are a little bit higher up in those second and third tier cities as well. And what's quite interesting is if we have a look at the next slide, the demographics of China are not on your side either. The last 30 years has seen the one-child policy, and this has led to a shrinking population. So the supply of labor is lower and tighter. Actually, very recently, the legislation has changed, and in certain circumstances, families are encouraged to have 2 children, but the impact of this will only come in 20 years' time when these newborns start to reach working age and can put some of that supply back into the market. So if we're talking about high wage inflation, then yes, it's true. The rate of salary expectations seems to be well outpacing the market indicators, but there are many economic, political, and demographic reasons that is going to continue to drive this for the next couple of years. So we'll now go on to our second challenge. And this second challenge is to consider, given that we have a high wage inflation that we've just talked about, what is the impact of that on the salary structure? And quite often a typical question or a typical comment we will get from our multinational clients who are operating in China is that their global structures and their global policies don't always work in China. For example, they may have a global policy which doesn't allow an annual increase of more than 10%. They may in China be promoting somebody just one small grade, and they're asking for a 30 or 40% increase. And again, the global policies have not necessarily been built to be able to flex to this. So this is a typical challenge that we see many overseas headquartered companies having in China. And I just want to take you through a couple of slides which tries to demonstrate this. So if we take the impact of wage inflation on a traditional pay structure, what I mean by a traditional pay structure is one where there is a midpoint to the grade, and there's typically a salary attached to that midpoint. So a new person entering the role might come in below the midpoint, say at 80% of that midpoint, and with experience they'll move up through the pay range to the midpoint, and for certain reasons they may go up above, but there'll be a ceiling of, say, in this case, 120%. So if we were to consider China, let's assume that we have a new or a newly promoted staff member. We're hiring this person at 80% of the pay range, and let's assume that for the conservative view we want to get them to that midpoint after 3 years, assuming they're doing the job that we're expecting. What we have to take into account is that that midpoint is moving up at 8.5% a year, because the midpoint is based on the market, and the market is increasing at around 8.5% a year. So, to give you a little quiz, we're going to have an interactive poll here. I'll just read the question. So, be interested for you to choose, what is the salary increase that you need to give every year to ensure this person moves from 80% of the structure to the midpoint after 3 years on the job? So if you can use the computer screens to just select 4.5%, 8.5%, or 16.5%, and we'll just give you half a minute to do that. Okay, so hopefully you've had an opportunity to select what you think what your increase is going to be. So the vast majority of you, 74% of you have said that you'll need to give an increase of around 16.5%. Yes. So if the salary market is increasing at 8.5% a year, and you are trying to move somebody from 80% up to the midpoint during that 3-year period, then you have to give them a 16.5% pay rise per year. 16.5% is expensive in many Western-based policies, and for an average performer, it might feel quite uncomfortable. And to make it worse, turnover rates in China mean that there's probably a large number of people in your organization that are new in their roles and maybe are trying to work towards a midpoint. So actually, you're probably applying these increases to quite a large population. And to add a further complication, not that many people in China will wait around 3 years in a role to get put to the midpoint, because it's actually quite a tight labor market. So you have quite some pressure to move them to that midpoint even faster. And just to make the complication even further, this is assuming that they are staying in the same role and there's no recognition of promotion happening. And there's one thing that we do know in China, there's quite some pressure to be advanced and promoted every 18 months or 2 years. So you can see now why in China some of this can actually really challenge a global policy or framework that might be in place. So what happens if somebody is also promoted? I want to share with you on the next slide what that might look like. If we have a look at a promotional situation, so there has been a rapid rise in senior management pay in China over the last 10 years, and this has created a very steep pay curve. So what I've tried to show you here is some data off our database, which shows that the lower end of the salary range in China is still quite low, particularly if you compare it to US salaries. But if you look at the senior end of the market, they are actually paid very close to US salaries now. But what it means is that in order for you to move through this pay range, your increases with each of your promotions actually has to be quite large in order to move you up this pay curve in China. And this is what we refer to as pay progression. So along the x-axis, I've put there the Hay reference levels, which tells me the size of the job. So typically, a clerical job is between 7 and 11, a supervisory or junior professional between 12 and 16, and a middle manager 17 to 20. So pay progression happens when somebody is promoted up a reference level, their salary is obviously equivalent pay goes up as well. And quite often we talk about a real promotion being a two-step move, so maybe a sales rep into a sales manager. This is what we call a two-step move, or going up 2 reference levels. And typically in China, a two-step move brings an 82% pay rise with it. Why is this? It's because multinational companies are wanting managers who have experience with multinationals, who are bilingual, who have management experience. And there's not that many of them around in China. So it's a very tight labor market that they're looking for people who can best fit this criteria and then paying them a lot to recruit them. So over the last 10 years, this has really been driving the middle and senior management pay up and up and up. And in many cases, what's happening is that companies are stretching somebody into that role who actually probably has little experience, but they need to put somebody in that role. And it's this pressure on these management salaries that's creating this very steep curve. But it also means that it's created quite a high expectation in China of people to move quickly up this promotion ladder, get regular promotions, and get large pay increases. So an 82% pay rise is obviously something that's extremely attractive for an employee, and they're wanting to do it even if in reality they may not be ready for that promotion. I just want to show you a comparison with some other markets. As I said, the two-step promotional increase in China is 82%. When you open the bottle of champagne to celebrate your promotion, if you have a look at some of the developed economies, you'll see it's typically between 25 and 33% increase. For that same job promotion in China is obviously a much larger increase in your actual salary because you have to move up a steeper pay curve. So given you're already given a 16.5% increase just to move you through from the 80% to the midpoint, you now have to consider giving some promotional increases on top of that as well. So overall, yes, if you have a rigid global structure and policy that's based on Western practice, you need to think of some flexibility of how you can work this in China. You will need to consider annual increases that may go above 10% for some people. You will be needing to consider some quite large increases for people who are moving up the pay progression. It does not mean that a China structure cannot be based on the same principles as a global structure. It absolutely can. It just needs some understanding of the realities of the market so that you can work through and make sure that these issues don't, I guess, hamper your business locally on the ground. So let's go on to question number 3. This is talking about wide range of salaries in the market in China. Because of the many issues that we've already mentioned, as well as the fast pace of growth that we're seeing in China, we find that China has a very wide range of salaries in the market for the same job. So typically, something that we might hear from a client of ours is that our staff complain if they go into the market, they can get twice the salary. And Chinese employees are renowned over the last number of years for job hopping, sometimes getting some quite good salary increases as they job hop, change employers, and even stay within a similar level role. So again, we've gone to our databases to try and show a little bit of why this is happening and show you that actually it is true in China. What this graph is showing you is what we refer to as pay dispersion. So what we've analyzed is China in the red, the US in the green, and Germany in the orange color. The upper 3 lines are showing you what the 90th percentile of the market in China, US, and Germany might be paying in terms relative to the median of the market. And the lower 3 lines are showing you what the P10 or the lower decile might be paying, again, relative to the median of the market. So if we assume, therefore, that the upper lines are showing what not the ultimate highest level of salaries, but fairly high level of salaries in the market, the lower lines are showing fairly low level of salaries in the market. What we can see in China is a pay dispersion of 300% or 3 times. What this means in reality is that employee A and employee B might work for 2 different companies, but they're doing the same job. Employee A happens to be positioned at the P10 of the market. Employee B happens to be positioned at P90 of the market. It means that employee B is actually earning 3 times the salary for doing the same job. So it's an enormous gap that can happen within China. And even if you position yourself at the median of the market, it still leaves an enormous opportunity for your employees to find the same job at a competitor willing to pay more. And actually, we did a survey recently which showed where we asked multinational companies how they apply their salary structures in China, and 2/3 of companies saying that they will hire below the minimum of their salary scales, and 3/4 will hire above the maximum of their salary scales. So you'll see in China that a real flexibility around salary scales. But if you have a look at the US and Germany, you will see that it's much tighter. Actually, particularly within Europe. In Europe, you find much smaller pay dispersions because pay in Europe is very driven by internal equity, equal pay for equal work. And so there's much more rigid pay structure, and you will see a much narrower band of pay in the market. But in China, employers have been willing to give in to the pay demands of those ideal candidates, and they've used their pay ranges very flexibly, or sometimes not even used them at all. And not surprisingly, it's led to this huge pay dispersion in the Chinese market that you can see. So yes, of course your employees can get more out there, but are you willing to pay that cost, and for what return? So some companies may be willing to do it perhaps only for a few certain key roles. The 4th issue we're going to look at that we're going to look at is to do with managers impacting turnover. And I guess the typical question that we see here is, can the high turnover be just about pay? Now, pay is an issue in China, but I'm sure that many of you know it can't be the only or even the prime issue. So let's have a look quickly at some turnover data. Let's see some data on turnover generally in Asia. You can see China, which is on the far left-hand side, is the highest even within Asia. China has a particularly high turnover rate, especially when we look at our data in those who have got 2 to 5 years of service and in those that are in the 25 to 30-year age group. And typically because these employees have got some good skills that are valuable in the market, they now can go and get these higher increases that we've just talked about. But if the pay progression that I showed earlier, where promotions can give you an 82% increase, it's providing a huge incentive for an employee to go out and seek a promotion early in China, and it drives the promotion. At the same time, you've got a real talent pool gap in terms of managers and leaders in China. And so basically what this is resulting in is that the managers and leaders in China are the youngest in Asia. If we look at our databases, we find that typically they are around 5 years younger compared to other Asian markets and around 8 years younger compared to a mature economy. So typically it means that these managers are being promoted into a role before they may necessarily be ready and before they would have been promoted if they were in a more mature market. It results in a young and very stretched workforce at the management level. We all know that a manager is often the reason that people stay or leave a job, and it's the managers who have the biggest impact on retention if they can engage their staff. So if managers have this biggest impact, what I want to show you now is how are this young group of managers doing in China in terms of engaging their employees. So using the Hay Group engagement databases, we know that China is weak in terms of employee engagement and enablement, and we know this contributes to a higher turnover. So Hay Group, when we look at engagement, we look at a two-dimensional model. On the x-axis, I've got their recorded engagement. So this is how engaged is a person, how willing are they to give discretionary effort and commitment to the company. And then on the y-axis, I've got how enabled is a person to do the job. Have they got all the training they need? Have they got all the support they need? Have they got all the resources they need? And if you use this matrix of engagement and enablement, in Hay Group, our model will put you into 4 boxes, 1 of 4 boxes. If you as an employee are engaged, so you're willing, you're committed, you give your discretionary effort, and at the same time you're also enabled, you have the support you need, you have the training you need, you have the resources you need, then you will tend to fall into the effective box. And we can see that China falls well below high-performing companies or overall global companies in terms of how many of their staff feel effective. If your engagement is high as well and you're willing to commit for the company and give your effort, but you are not enabled, you're not trained, you're not supported, you don't have the resources, you end up in the frustrated box because you want to do something and you can't. If you have low engagement, you're not committed, you're not willing, but you have very high levels of support and training and resources, you end up in what we refer to as detached. And I guess the worst scenario is when somebody is not engaged and they're not enabled, and they end up in the ineffective box. They're ineffective in terms of actually producing a performance that will drive the team and drive the company. And we can see China has a large number of staff falling into this ineffective box. On the next slide, I'm just going to show you some of the main reasons. A recent survey we did last year showed why an employee may leave. So yes, pay is included amongst the reasons that people are leaving. But there are other reasons that a manager could really have a big impact on. Growth opportunities, utilization of skills, role stagnation. So I guess what we are saying to many organizations that are faced with the situation in China is to really ensure the development of your very young managers and young leaders, because this will assist. It won't resolve, but it will certainly help assist in some of the turnover and therefore some of the pay issues that you may be facing in the market. Okay, we go on to the fifth issue. Skills do not match demand. Typically, what we hear about is 7 million graduates coming through the system a year, but we can't find anybody to do the job we need done. So we know that China has the largest population in the world, but there's nobody to do the job. And we hear this most at the graduate level. So I just want to show you a little bit of the data. Here is a chart that shows you the supply of graduates that have come through China over the years. And you can see over the last 10 years that there's an enormous influx of graduates into China. There's 7 million graduates a year at the moment that are coming through the system. The Chinese government changed the education system a couple of years ago, which has created this influx, and perhaps has also created some of the issues. So if we go on to the next slide, what this is demonstrating is that although there are many, many graduates, we see these same graduates are struggling to find work, and yet on the other hand, we are continually hearing from companies that they are struggling to find graduates with the qualities that they need. And so basically what has happened with the change in education system that happened a number of years ago is that the current education is not aligned with the required skills that are needed by the companies. And there's quite a misalignment there that is certainly causing a lot of difficulties in the market. And so you as an employer need to put programs in place to really further educate and develop your graduates in China. Perhaps hire interns into the organization and train them up even pre-employment. So there really is quite a lot of work that you need to do up front when you're actually bringing graduates into the market in China. We did a graduate salary survey at the end of last year, and just a couple of points from the results. What we see in China is that the level of degree can really differentiate the salary. So if you look at the same management trainee role, if you have a PhD as opposed to having a bachelor, you'll earn 50% more salary when you're hired into that. So the level of your degree really will impact your first salary as you enter into the market in China. From our analysis, we learned that only 4% of the senior management actually came from the original graduate intake. So you can see obviously a very high turnover of those graduates. Everybody agreeing that it was the development opportunities that were the key priority of these graduates. And interesting, more than half the graduates have already had a promotion within 18 months of joining that organization. So again, leaning back to that very strong push for very early promotions in China as well. Now we're going to go onto the last question. This is talking about diversity. So China is a very diverse country. It's something that you will see reflected in the cities, the workforce, the variety of company types that exist out there. And all these differences mean significant disparity in the pay package, and that can create quite some challenge as well. So a typical comment that we might hear is, I'm using the China general market data, but our local HR are saying that they cannot recognize this. So I'm just going to walk through a few points of the market data so that you can see why this might be happening. The first diversity we'll talk about is diversity of geography. So pay tends to be quite different in first-tier cities. First-tier cities are, well, let me step back a little bit. China has around 600 cities that have more than 1 million people in them. So, I mean, in terms of cities, there are literally hundreds of cities here in China, but there are 4 first-tier cities: Shanghai, Beijing, Guangzhou, Shenzhen. These first-tier cities are typically the ones that over the last number of years have grown significantly. They're the ones where most leading companies are headquartered and are operating out of. And they, because of that, have driven the largest salary increases in the past and have now got, in these cities, have got senior management earning same and sometimes even more than what their Western counterparts might be earning. But if you look outside of these first-tier cities, you'll see there's a huge gap in the variety of pay that will come across the geographies. So what we've done is a simple analysis here from the database where we've selected some non-first-tier cities and we've compared them to that of the first-tier cities. And what you can see on base salary is that anything from 18 to 25% lower in a non-first-tier city might be the data that's coming through in terms of the salaries. However, be aware that what we showed you earlier was that the minimum wages and the pressure is now on those second and third-tier cities. And so we are expecting the gap to close, but at the moment the gap is still quite significant. So you need to know which cities you want to compare to, and you need to use like our city index, for example, so that you can actually adjust your general market according to whichever city it is that you are looking at. So that's the first area of diversity. The second area of diversity, China has 1.3 billion people. It's the largest population. And with regard to pay, there's several categories of employee in China. These categories include your local Chinese employees, your expatriates, your locally hired foreigners. So actually this is quite a growing market over the last number of years. A locally hired foreigner is somebody who has worked, who is born and worked in many of the Western and mature markets. They've come into China and they've decided to localize themselves. So they're not on an expatriate package. They go into the market and they look for jobs locally and they get hired as locally hired foreigners. But they still have a premium in their pay over the local Chinese employees in many cases, because they have the understanding now of the local market as well as the headquarter or home country market as well. And then there's a fourth category, which is called the Chinese returnees. And again, this is also a growing category. If you think of the last couple of years when many Western and mature markets have struggled and maybe haven't been able to give a lot of opportunities, China has been booming. So many Chinese citizens who went out of China to either educate themselves or to work are actually returning back into China because there's huge opportunities for them now. And the Chinese returnees are actually also gaining a premium in terms of their salary because, again, they've gone out of China, so they've been exposed to the headquarter country cultures and style of working. And so for a multinational organization, these Chinese returnees are certainly very interesting people in terms of the employment market as well. And we're actually seeing an employee segment and some data variation coming through in terms of what the Chinese returnees are earning in salary as well. The third area of diversity that I want to talk about is the diversity in the company ownership. So there are three main types of company ownership in China. There's a state-owned enterprise, which means company is operated and owned by the Chinese government. There is a private-owned enterprise, which means it's a Chinese-owned private company. And then there's a multinational, so the China branch of a multinational company. And in China, the ownership of the company has also influenced pay in the past. So just briefly to sort of give you an overview of this, the state-owned enterprises will offer a lot more in terms of benefits and allowances and work-life balance. So they are the Chinese government owned and operated companies, and they really tend to offer benefits and allowances as in terms of attracting. The privately owned enterprises, they offer much more in terms of allowances and variable pay or equity even. So they can offer a higher net also because they quite often are able to give some tax efficient allowances that they can offer to their employees as well. A multinational corporation tends to typically offer more base or guarantee. So they tend to be offering a higher gross package. But the global compensation policies of these multinational corporations are really quite under pressure because they don't always drive the right behaviors that are required to push the very aggressive China growth strategies. The incentive schemes can quite often be a little bit too moderate compared with those Chinese companies who are putting much more pay at risk, the Chinese private companies who are putting much more pay at risk. So hopefully you can see that the diverse geography, the diverse workforce, and the diverse company ownership in China all can have an impact on pay. So you just need to be aware of what your data is including and make sure that you're not having one of these potentially dominating or slightly skewing the data. So really that's coming to the end of the presentation that I had prepared for you. I just want to show sort of a final challenge that we often hear in the market. The talent shortage means we can't hire in the market. Our internal candidates don't possess the skills we need, and our competition is nevertheless offering them more senior jobs. And absolutely, this is what we believe that you'll feel and see when you're in China as norm. There's a growing market, a shrinking population, a high demand for a very small pool of bilingual, multinational experienced staff, and you need to take some risk on your internal candidates and develop and stretch them, but really support them into those roles. Because if you don't do that, somebody else is going to come and poach them and offer them that same level of job that you were too nervous to do it. So hopefully a little bit of this insight into the wage inflation and the salary structures, the diversity of the market can help you make some good decisions then in how you will pay your staff. So that's the end of my presentation today, and I hope you can walk away with some learning from that. So thank you very much for your time and attention, and I'm going to hand over to my colleague Larissa. She's going to facilitate the rest of the webinar.
Thank you, Wendy, for going through that great presentation and sharing all that information. I just wanted to take a moment to inform those of you on the call of Hay Group's latest product, Hay Group Activate. Hay Group Activate is a suite of apps designed to transform your HR policies into real-world results by empowering managers to take more responsibility for their people. We currently have 3 different kinds of apps that we offer: Leadership Styles and Climate, Grade a Job, and Price a Job. Descriptions of each of the apps are on the slide right now in front of you, but you can also learn more about them on our website listed on the bottom, www.atrium.haygroup.com/US. You can also find out more information on our other products on this site as well. Now, before we get to your questions, we actually have one last question for you to fill out. So just please take a moment to just select the categories that you would like to learn more information on. There's pay, talent, effectiveness, and Hay Group Activate. Thank you so much, everybody, and thank you for your responses. I just want to remind everyone that today's webinar was recorded and will be posted to our website. All attendees will receive a copy of the slide deck that was presented today, as well as the recording, in case you would like to reference it again in the future. Now, at this point, conscious of time, we're going to go through as many questions that came in through the chat as much as possible, so I'll just dive right in. So one question that came in says, can you briefly mention what you are seeing with LTI and or equity programs in China? Wendy or Joe, could you please answer that?
I'm going to pass it to Joe, and Larissa, just let us know if you can hear us clearly because we've put it on speaker, okay?
Okay, for this question, actually for foreign companies in China, they normally provide the LTI equity programs to their executive level employees. You know, sometimes Hay Group China consultants try to collect this kind of information from local HR, but we found it's hard for them to provide this kind of information in China locally. So, however, some Chinese local companies, especially for some start companies that grows fast, to provide this kind of LTI and stock equity to all the employees in different levels. For some leading China companies like Lenovo or Baidu, such as Google, they also provide this equity or LTI programs to the direct or above level employees. So that's what we learned in the China market.
Okay, great. Another question that just came through asks, how are companies handling the fast pay progression that you spoke about?
Okay, I'll answer that one. So I think what we're seeing many companies wanting to do is they're trying to find ways of recognizing a step up or recognizing a move or that somebody has made within an organization not necessarily into the next global grade, but at least finding ways of perhaps putting a mid-step in place or some way of recognizing continuous progression every year or every 18 months, because that'll help the Chinese employee get the same feeling of progression that they get from when they're looking into the external market as well. So they're spending a lot of time on training and development, getting them up to speed, and then finding ways of putting some mid-steps or some recognition points in place so that those employees can continually feel that their progress is being recognized. It may not get the actual new global grade step, but it's getting maybe a China mid-step recognition or job title change or something like that.
Okay, great. Thanks, Wendy. Another question that we have from our attendees is, what is the most common tool that most companies, particularly multinational corporations, are using to retain and attract?
Okay, so I will answer this question. Actually, in China, we use different tools to retain employees. One is for financial aspects, and another is non-financial aspects. For non-financial aspects, we found that many foreign companies use different tools to retain employees. One is about overseas job opportunity. For example, one of our clients is a leading IT company whose employees are always attracted by some other local IT companies. So in such case, it's easy for them to provide this overseas opportunity to retain their employees. So especially for the younger generation that willing to work overseas and to gain some overseas exposure, so this is good retention tool we learn in the market. Another factor is about the culture. In China, the foreign company's culture is almost the same. It's not only for the Europe company or US company. The culture is good. Respect people, the authorization, and also provide some good benefits. But for the China companies, the culture is really different in different companies. So sometimes we just found out the culture is also a good retention tool for some employees as well.
Okay, great. Thanks so much, Joe. For all of those on the call, if you do have questions, just keep sending them in through the chat. We'll try to get through as many as we can as possible. Conscious of time, we'll keep going with all the questions. Another one that just came in asks, when we hire from the market, there seems to be many allowances that are being offered. What are they?
Okay. So quite often what you see happening in the market is the privately owned Chinese companies or the state-owned Chinese companies appear to be offering allowances that are tax-free. What you will find when you try and investigate these as a multinational company is that quite often they fall into a fairly gray area of China legislation, and your own tax and audit policies and your own tax and audit structures probably will not allow you to be able to use some of these same loopholes or gray areas that local companies are using. So it's actually quite hard to compete directly with some of the allowances that are being offered in the market. So you will hear of service year allowances, level allowances, allowances to allow employees to go and do training, and they're doing it on a reimbursement basis, which means the employee is not necessarily paying tax on that. But again, what you'll find, what all our foreign-owned companies tell us is that most foreign-owned companies cannot apply these because of the tax and audit that we have to comply with. However, something that has actually come through recently, there's a change in the legislation in December, where now there is a tax-free contribution on the entry contribution to a defined contribution pension or retirement plan. It's known in China as the Employee Annuity Plan, the EAP. I think it's the China version of, in the US, what you call the 401k. So this legislation change that happened in December allows an employer to put a tax-free 8% contribution into the plan, and the employee can put a 4% contribution in. And what's quite good about this employee annuity plan is that it's completely movable. So when the employee moves to another organization, this plan can move with them. this has been quite welcomed in the communities because many people in China are getting quite concerned about their retirement and their pension. If you have a look at those demographics we showed you earlier, with a shrinking population, there's a large number of aged people who will be leaning on the state. And so there's more and more people who are starting to now worry about what they might need to be doing in terms of retirement and pension. So quite a number, the legislation's only recently changed, and quite a number of multinationals are starting to look at this in China and considering whether they might be able to do something.
Okay, great. Thanks so much. I want to thank you both for going through all those questions. For any questions that we didn't get to, Wendy and Joe will follow up with you personally. That concludes today's webinar, so I wanted to thank all of you for listening to our presentation today. If you indicated that you wanted any more information on any of our tools, a Hay Group representative will be in touch. And if you need to reach out directly, please feel free to reach out to Wendy, Joe, or myself. Our contact information is listed on the slide right now. Thank you, everyone, for joining us, and have a great rest of the day.